So today we are going to look at liquidity, which is one of the most important thing that everyone needs to take into account in terms of um, this market, this
Yes.
forex market. Liquidity is one of the most cardinal thing because reason being, market makers don't move the market before they take liquidity. What is liquidity? In other words, liquidity, this is money. Liquidity, this is, for example, if you say a liquidity zone, this is an area where money is. This is an area where you're likely to find money. And market makers would always come back to those areas, take the money, and after they take the money, then they move the market. Okay, in other ways, again, you can say liquidity, looking at just by the word itself, liquid. It's just more like fuel. Okay, fuel. A car cannot move without pumping in fuel. So liquidity can be put in that area to say that this is the fuel that drives the market in a particular direction. Okay, so
Yes.
Uh, before you look at liquidity, you need to understand how market makers would like to play with our minds. Let's say the retail traders and everything. A situation where market, you hit the buy, maybe for example, you see an information, you hit a sell, later on you're taken out. Immediately you're taken out by just a few pips, then that's when you see a big move. Then you start questioning yourself to say, what actually happened? Because everything is what? I just took everything into consideration and so on and so forth. So it's important that as you're looking at the part of liquidity, make sure that you're looking at the stop runs or stop rates. Okay, the stop runs and stop rates, these are basically the the stop hands where the situation where you're taken out of the market without even you realizing it. For example, once you're in the market, you trade, then the market stop hands you takes you out, then afterwards it goes in the other direction. So uh, there are a lot of types of liquidities that we have. There are a lot of type of liquidities, but in my case, we're just going to look at a few that I mainly put into account, mainly which I put into account. So there are a lot out there, and there are ways in which people try to identify where is liquidity, where is the market going to reach. For example, how are we going to marry this concept of liquidity? We looked at market structure. We looked at the areas where market would likely to what where are going to is likely to retain, or why is market maybe chasing a particular high. We looked at how market structure is working and the breaks. So now we are adding the concept of liquidity so that we should at least have a second reason why we should find ourselves looking at a particular pair and everything. So now, how are you going to put everything together, looking at the market structure perspective and combining it with liquidity? So we have, like I said, we're going to just look at a few, but there are others out there who can identify liquidity in several ways. Okay, so the first one that we're going to look at is maybe we'll divide them into two, which is the visible and the hidden liquidity. So the first one is the visible liquidity. The visible type of liquidity, this is the one that is well known by most of the people. Uh, and this type of liquidity is almost known by the retail traders and uh, and even us. I'm sure when we were doing the retail, when we we're in the retail world, we used to see a whole lot of information. The information is known to be a pattern that is a reversal type of a pattern. Okay, every time we see an M formation, we see a triple top, we see that it's an M formation on and so on and so forth. Then we'll just visualize it and say, okay, that's a reversal pattern. Yes, quite all right. It's a reversal pattern, but the question that we need to ask ourselves are which M for formation or which M pattern is valid and which one is not valid. That's the question that we not get what. So sometimes we find ourselves price creates equal highs, then it breaks the neckline in a retail concept. If it breaks the neckline, they'll obviously want to see price retesting on the neckline. And after it tests the neckline, then that's when they want to shoot to the downside. But what does that tell us? But you and I would wait for price at least to grab some liquidity and to give a proper reason to why we're going to what? Finding ourselves in the market. So we're going to look at this guy here, which is the equal highs, the common one, and we're going to identify them in different ways. And we're going to also look at the hidden type of liquidity. Okay, market, the retail traders will look at this when market is moving like this, for example, in a trend line formation. Obviously, as market is bouncing off those trend lines, they expect to be buying. They expect to be buying or at those points. But in the market makers' perspective, market makers are creating liquidity here, liquidity there. How are they accumulating liquidity in those areas? Every time when a retail trader sees the bounce, what do? They'll enter a buy here and put their stop loss somewhere down there. Again, when it bounces somewhere there, they'll put more entries, more people will enter, then what? They go up. Then they put their stop losses there. But what is happening at those points? There's liquidity down there. There's fuel that the market makers would need in order to what? To find themselves pushing the market. So what are they going to do? They are going to like raid them all. That's the reason why you find a big move, taking all the stop losses, stop losses, stop losses. Market will shoot. And as it's shooting here, this is a time that you realize that it will be shooting with the big move. Why? Because it's getting all the fuel that it needs to push the market to the downside. Then the retail guys will go like, okay, now it is broken, now we can go in. Maybe the market makers will just want to play around again. That's when they will shoot. Then we'll look at those examples when we go to the live chat. So we looked at this in the last lecture, which is the common one. Okay, so this is the common one, and it's the one that I like the most. The previous month high, previous week low, previous what? Because the reason why I like this, if I find price has reached my previous month high or previous months, like it can be all the previous years and everything. So if I look at that, I find that price has reached that area. And if I zoom in further, I find that price has reached that area as well. Then the last one, I should find that if price reaches that area and beats that area, then I should be looking for a good entry there. So as we move stage by stage, we'll be able to understand them nicely. Then we have got the other one that we're going to look at. There's a New York type of liquidity, but in my case, I like the Asian type Asian session type of liquidity. And I'm going to show it to you as well how it plays out. So, and how you can capitalize and use it in your trading plan or trading, your ways of trading, how you can maybe add it to the way that you trade. Okay, so let's go to give an example of the eco high. The eco high type of liquidity, we mentioned to say we'll see eco highs. This can be a previous month and maybe a present month happening, creating eco highs. Okay, after that, maybe market makers would what? Would make a break here. Okay, a fake breakout. And how will the retail traders see it? The retail traders will see it to say, okay, since this is a break, you are seeing eco high. And in your mind, you're like, oh, those guys have to come back and grab those liquidity. Okay, so after they have seen an information here, the retail guys, after they have seen even a fake break here, what do? They enter after the break of the neckline, then they're in the market. But what are you waiting for? At least you need to wait for price to take out these eco highs. Then you find that later on, they're out. After they're out, you are waiting for this. If you don't see this happening, you're not in a trade unless you have got other reasons why you are entering the market. So afterward, what do? You find yourself after the break with the void. We'll look at that when you go to the order block sessions and everything. So after you see that break, that's where you'll find yourself in the market nicely. So this one also happens in the similar manner, and they are all mostly there. So all you need is just to do a hell lot of practice, and every time when you find something equal like that, just check, play around there, and see how market reacted towards those areas. And if you look at it in the retail perspective, just think of how you could have been stopped out if you viewed this, for example, as a break in neckline. Okay, then you are out. Then later on, that's when the market comes up. Then you're confused. Okay, so let's go to an example. An example. This one is based on a real setup that was taken. I think that was in January. Yeah, we monitored this with the guys and stuff, and I think it was a very good trade. So what we saw was equal highs here, okay? Equal highs of gold. Then after we saw equal highs, and this is a previous day, okay? Previous day and the following day. So we saw equal highs. After we saw those equal highs, what did we get? We saw price breaking, creating a form of an SMS, which is a shift in market structure here. But you should have it fit to your mind to say that this is like equal highs and there's liquidity that might be created on top there, okay? Afterwards, what did we get? We got a break in market structure. So the retail guys have seen an information and it has broken. In their mind, they want it to retest the neckline. They maybe put their stop losses up there, then that's when they are going to shoot. Okay, so if they are holding, they are happy that we are in the market, everything is happening, everything is all good. But the following day, what happens? Market just starts to go up, 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 until those equal highs were what? Taken. Immediately those equal highs were taken, we saw a good break in market structure, which we follow, okay? And the market bounced off, we take our orders from there. Then that's when we find ourselves in the market. And this market like moved to the downside. That's where we enter. We enter reason why, because we have put everything into account. Equal highs, okay? Fake breakout. We want to see price taking out these equal highs. Then afterwards, market, what did it do? It created some form of a low. After that low was broken, then we have an idea that okay, market will come back to that area. Okay, so that's how we would look at the concept of equal highs. Equal highs, yes. Then the concept of equal lows again can happen in a similar situation where we see a previous week equal lows. Okay, this is one, let's say 1, 2, 3, 4, 5, 6, 7. This is like maybe there's a Friday here, there might be a Friday here. Yeah, there might be a Friday here. This can be a previous week. Instead of price, maybe after reaching here, continue to go up, it even creates more equal lows. So what do you expect price to do? After at least for some 1, 2, 3, for some like 3 days, what did we expect? We found that market came back, grabbed all the guys here who saw this in the bigger time frame that it's a what? It's an information, or it's time to buy now because it has reached a support or resistance level. Here they were out. After they were out here, that's when the market makers did what? After they were out, they started breaking more higher. See the importance of market structure and how the market breaks is, okay, they broke, returned to the origin, and that's when they started moving up. But what does this same scenario just tells you? It tells you that market makers will only make a big move only after they have grabbed liquidity. So it's highly important that we take note of those liquidity every time before we are finding ourselves in the market. Before you take a trade, you need to identify where is liquidity, where is the market, and where is the market going to go. Okay, so here we have liquidity everywhere. For example, as we are going to marry, for example, we're in a trend line perspective, which we're going to look, this is liquidity here. Okay, market would want to come back and get it because this is a trend line enticing people that will bounce from here, will bounce from here, will bounce from here. So a retail trader again would extend the line and say, oh, I think this is bouncing, bouncing, bouncing. I think we're going to come back and bounce. And what did you do? It will entice them. Yes, they have put, they're just in a few profit. What happened? They're out, just like that. Okay, here, even down here, there's liquidity down here. For example, these are more like equal highs, equal lows, rather. Okay, sorry about that. These are more like equal lows. These are equal lows. Okay, equal lows might not be as exactly equal, but at least if there's a small deal, for example, these can be considered as equal lows. Why? Because they just a small distance, and depending with the broker, you will realize that the other brokers will be like more equal. Okay, just like here. So this was what? More liquidity, telling us that market makers would want to, before they shoot to the upside, at least let them take these lows. In the process of taking these lows, we would like to see price taking these lows, then we start breaking. And that's when we are going to find ourselves in the market. Okay. So Asian session type of liquidity can be visualized in this concept. So Asian type of liquidity, I use it mainly when we're looking at the part where market is in a particular trend. Okay, market as we looked at, we said that when market is going up, then it reaches a particular area that we are anticipating that price might likely to start turning. Then it starts to turn, it starts to break lower and everything. So the movements that the market is going to make here as it is going lower, and I want to capitalize such movements and the like. So I would use the Asian type of scenario for me to find myself in the market. I would utilize the Asian type of liquidity for me to find myself in the market. For example, market reached a particular area, then it started going down. So when Asian is well known by its consolidation state, it likes to consolidate. Okay, to create like this, it will create equal highs, it will create just that range. Okay, so it's well known by its state of consolidating and also accumulation of liquidity or manipulation of price. Okay, so market Asian will have the high and the will have a low rather and a high. Okay, so before I find myself in this situation, not that if there are a lot of ways in which you can trade this type of a scenario, but for me, I only trade it when it's in the trend. Okay, it's in a particular trend, so that my entry reason should be supported much by the trend of the market. So after seeing that market is in a bearish condition, I would like to see when price for the particular day ranges, it will create a high and a low. Okay, after it creates a high and a low, I would like to see price taking out the high first. Okay, after it creates a high, I would like to see price breaking the low. Then I will be able to know that, okay, there's an Asian type of liquidity that has been created and I can still take lower, provided that I've got an order block somewhere. Again, another situation will happen. Market will range in an Asian session, and after it ranges, it will create a high and a low. If I know that I'm only looking for sales, I should see my high being taken out for that Asian range. After it has been taken out, there should be vulnerable. There should be a vulnerable order block that is a line somewhere there, and it's the one that we're going to take. So it's going to be more quick and more great if we look at the order blocks in our sequencing. So just like this in a bullish condition, it will be a similar situation. Okay. So on a graphical perspective, this is how market will be. This is for a particular day. Market ranges and breaks. Okay. After breaking, you return to the order block. Just like that. Again, we go to the second Asian session. This is the previous day. The following day, market gives a range, gives the Asian session low, Asian session high. We would like to see price taken. If we are in the downtrend situation, we would like to see price taking out that high, Asian session high. But as it is taking out that Asian session high, there should be a vulnerable order block that was not initially mitigated, that we are going to target as our reason why we should find ourselves in the market. Then later on, shoot. Again, for a particular following day, what are we getting? We're getting an Asian high, Asian low. We would like to see, since we are still in the downtrend and we're only looking for downtrends, okay? So we are seeing market taking out that high. What is the vulnerable? Where is the vulnerable order block before that? And where is it? Where is that order block for me? Okay, that order block should have the likes of the void, the gaps, and the like. Okay, so that's where we're going to watch. So there will be liquidity above the highs and lows of the Asian session. Okay, and this will happen normally. This Asian session will be broken normally at the London Open. Okay, London Open market makers normally, that's where we'll take out those highs and lows. Okay, so in a similar situation again, where price will just bounce off the Asian again, bounce off. What did he do? Goes down again, bounce off, go down. So this Asian type of liquidity can be easily identified on how well liquidity is, where market is going to go for that particular morning before you find yourself in the market. So it's going to help you to identify the direction, also identify the bias. Okay, so basically that's it about this, and it requires you to, but unless if there are any questions, requires you to practice a lot, check them out so that you see them more. You might see more than I knew. So the trend line liquidity, again, like I explained earlier, so it will be a situation where market is breaking higher. The retail guys would want to see how price is going to bounce off this, and they're going to be taking small buys. But if they are holding from here to here, market makers would want to come back and grab them all, taking them all. Then that's when they will even continue maybe to go up. Okay, similar situation. You can combine these now together. Okay, where you see a previous day or previous week being taken out, then you're seeing a good break in market structure. As you're waiting for price to come back to that origin where everything is happening, you can experience liquidity is there. So liquidity that is there on top here, like this, it will be, you anticipate that it will be taken out with this move. All the stop losses that are saying sell, sell, sell will be taken out by this move. In the process of taking out liquidity, you are using that information to take out the liquidity down. So you're using, it's okay, these ones are liquidity, so they'll be taken out by this move. Okay, so in the concept of like going now to the real chart, and let's identify this type of liquidity of a trend line. So it's not always that it's a mandate that you need to use all these types of liquidity. You can just take one or two to work around and see which one just best makes your chart clean, because you have to make your chart clean. So for example, here, you see, we are in an uptrend. And market broke nicely. Again, market broke nicely. But as market was breaking nicely to the upside, what did it leave? It left this low and this low. And how do you identify that this is a true liquidity? And why? Is because there are stop losses here. Okay, so when market created this one, it created these two. For example, you say, no, we would like to see market creating a third touch in the retail perspective. They'll want to take a buy from here. Quite all right, yes, they'll eat something, but it won't take them anywhere. The greedy comes in, you don't know where to put your stop loss and everything. There are a lot of people who have entered here. What does the market maker do? It will just take you out. All of you with your stop losses here. Why? Because you are looking at it in the market maker's perspective, and you're looking at this as some type of liquidity. And market makers would want to come and grab that liquidity before it goes up. Another scenario, a similar situation here. Market will create something like this, something like this. What is the anticipation for the retail trader who is trading trade lines? The anticipation, I don't know if they'll draw this, I don't know if they draw this. Yeah, I think it's like this. The anticipation is that, okay, market has bounced off, bounced, oh, it's an uptrend, market is going like this. They would want to take a trade from here and shoot. But what are you seeing? You're seeing that market has created liquidity here, and it might want to come and grab it. So if you want, you can use the trend line liquidity. If you want, you can use this concept of previous days high, previous days low. Reason being is simple. There's always liquidity lying between the previous weeks, previous days, previous one. If you want, you can just use the lines that there's money there and market makers would want to come and get it. If you want, you can use the concept of trend line. For example, it's hidden here. Here we are looking at it as previous day, but here it's within the day, the day, just within, more like within the day. Okay, but if you want, yes, you can just put lines and say, okay, there's money there, there's money there, there's money there. But you don't want to sometimes to make your life difficult by making the chart dirty. Instead, you just maybe put a trend line and tell yourself that market makers would want to come back there and rate them out. So a retail trader will see this as a bounce area where market will be bouncing 1, 2, 3 bounce. But what are you seeing? You're seeing that market makers would like to come and get those stops immediately after it finished doing whatever it wanted to do. All the stops are out. So you trade where the liquidity is, because that's where what the market makers are following. So you're trading with the liquidity. Okay. Another situation here, then the best encouragement that I can encourage you is that as you're looking at this trend line liquidity, avoid trading. For example, if you're using the trend line liquidity, so for example, here is the previous day, previous day, previous day, previous week. I don't know if it can be all that. Then you don't want to draw lines. Instead, you decide to say, okay, since there's money here, let me just draw a trend line. So I'd like to see price in one way or the other taking this out. Why? Because I'm seeing people who look at this, okay, it will bounce, it will bounce. Yes, it might give them money, but there are positional traders again who might enter here, they will be out at some point. There are others who might be greedy and they want to just enter, they'll be out at some point. So what am I looking at? I'm looking at this guy, or for example, here again, here, what happened? Obviously, someone else will come, no, it will bounce from here, they were out. Here, they'll want to say, oh, I think when it reaches here, for example, if we extend here to here, it will bounce back because it's in an uptrend. What did they do? They were out. Breaking market structure keeps on going down until it reaches a particular level that we are anticipating the price might come back down. And this was a very good trade again on gold. I really loved it. It was a very super one. Took it from there to there and it was shared. Everything was all good in the VIP. And we increased our accounts with a lot of percentage with this trade. It was a very good one. Again, price. Why are we trading a sell at this particular time after we see this? We're trading a sell because we still have unfinished business down there. So for example, current market created equal lows. Remember the concept of equal lows. Market makers might want to come back and take them, which they did. Remember the concept of maybe liquidity on trend lines. This is liquidity, this is liquidity. Market makers would want to come back and take them. But in the process of coming to get liquidity, what are we looking at? We're looking at how we can find ourselves in, and as market is fighting hard to take liquidity there, as we're taking advantage of that. You see? So What I was saying also is if you see an order block within a trend and type of liquidity, avoid such type of what? Of an order block within that type of inside the liquidity. Reason being, most of them won't play out within the trend line. Why? Because there's liquidity down there. So if you look at trend line like this, market makers would want to come back and take it out. That's when what? Which happened here. Okay, so if you say, okay, this is an order block that was not mitigated, you put your stop loss down there, obviously you will be out. Reason being is because the order block is within the liquidity trend line and it won't hold price if you don't put everything into account. So it don't. So others will take others will because they put all their own reasons. But for me, I've noticed that if I'm using a trend line liquidity, then I find an vulnerable order block within that, then I won't take it. It won't hold because market makers would want to come back and do this. Okay. For example, here, like this, there's an order block here. Obviously, others will go like, ah, no, I think this was order block is going to act or hold. But where is the trend line? The trend line is telling us there's money, money, money everywhere. So market makers would want to come back and you will be out. It won't hold. Okay. It won't hold as for a long time. So basically, that's it that I wanted to look at in terms of liquidities and types of liquidities. So the best way is to practice them one at a time. This is the liquidity. I'm looking at the previous week's high. I'm looking at the previous months. This is the type of liquidity. Look at them one at a time. It will help you to grasp or uh, have them understood one at a time if you can identifying them. But then it doesn't mean that you should use everything that you're seeing and try to what? No. Yes, you can use everything, but provided that you understand and you're able to apply. But if you're unable to apply, at least take one or two, put them together and say that, okay, this is what you're going to be using to understand where money is or where is liquidity.